This is Scott Bauer with Prosper Trading Academy and your CBOVol 411. One way to measure volatility is through the VIX, and there certainly is a seasonal effects to VIX levels and market performance. Volatility in the markets has followed its historical trend as the VIX this year has surged almost precisely on cue. From mid-July to the first week of October, the S&P dipped over 8% from recent peaks. Traditionally, this week marks the final stretch before we transition into the holiday season and see VIX lower. Overall, though, the VIX shows a well-defined seasonal pattern. The daily average of the VIX Index of short-dated U.S. equity volatility from 1990 to current shows VIX gradually declines during the first half of the year, bottoms in July, rises through October, and then declines in November and December. Investors care about the VIX because of its correlation to equity prices, at least in the short run. When the VIX rises, equities usually sell off or at least turn more cautious. Over longer time frames, this relationship is less reliable. Over any stretch of time, the primary driver of equities is going to focus mostly on earnings and the economy. Average levels in the VIX since its inception going back to 1990, excluding 2008. In January, just under 19. That drops to just under 17 by July, back to the low 20s in October, and drops back to under 15 by December. This is Scott Bauer with Prosper Trading Academy and your CBOVol 411.